Hi everybody, I'm Stephanie with the Salanik team at Long Foster Real Estate and director of the Salanik team REIG group. It's been about 3-4 years. It started as a group. We met at the Artesian Wine Bar. We've met at Bravehearts in Hellertown. We've done some on-site rehab tours as well. Awesome group of people. I am very excited to do webinars online now so that more people can see our content, can hear our topics, even if they can't be present in person when somebody wants to be a part of one of our discussions. So I encourage you, if you have questions, you can definitely log in. I'm going to talk for a couple more minutes while we get a few people to log in. I know it's been a little tricky switching over from in-person meeting to doing this online. I know some folks have had a hard time getting into the group and getting accepted. So most of them wind up viewing the videos after we're finished with them. So today's topic is about tax savings. I know as a real estate investor, as a real estate agent, tax time is always the beginning of our busy time, as well as the most stressful time while we wait for our accountant to tell us what our tax liability is for this year. So my number one recommendation is to partner yourself with an awesome accountant. I have put the contact information for the accountant that we use in the comments section. So if you need a recommendation for an awesome accountant, I can personally attest. We use Bill McKernan to do our business tax returns as well as our personal tax return, and he's available for questions for me throughout the year. Pre-planning, anything that we need, I quick send him an email. He usually gets back to me very quickly with an answer. So I love working with him. So I wanted to talk today about a few different types of topics, and I'll roll from one to the next. First topic I wanted to talk about was what is considered capital gain income and what is considered ordinary business income. So if you are a newer investor and you started investing by buying properties in your personal name, when you sell a property or you have income from the rental on the property, this is what's considered capital gains because it is in your personal name. Where if you started an LLC or incorporated before you purchased that property, now you have what's called ordinary business income. These are taxed at different rates, so it is important that when you start in real estate investing, you start off on the right foot. You start with an LLC so that you can use your business entity for ordinary business income. Tax rates this year have actually decreased on ordinary income, where they were 28% before. With the new tax laws, it's come down to about 22%, depending which tax bracket you are in. Sorry, I keep looking down. I'm just used to looking at the screen instead of at the video camera on the top of the computer here. So ordinary income tax rate decreased, or your business income is taxed at a lower rate than capital gains as well. So it all depends how you buy that property and how you file a tax return to know what rate you're going to pay on any appreciation or income that you have produced from these real estate investments or being a realtor. So another thing I wanted to talk about, especially right now, because in the last week, interest rates have gone down, and we're actually anticipating getting below 4% in the next week or two. Those are the lenders I work with. They're talking to me about it. They think that we're going to get below 4%. Why is that important? If you have a property, a commercial loan on a property, a residential loan on a property, I mean, definitely take a look at what rate you are paying. Call a lender you know and trust. See if you can get a better deal to refinance right now. I mean, now is, I've said it before, it's the perfect storm, but I can't believe rates have gone down and that lenders are telling me that potentially for 30-year residential mortgage that you could get below 4% depending on your situation. So there's not necessarily a tax saving tip, but a money saving tip. Because I'm a realtor and I'm seeing what's happening these days, and rates have gone down. I mean, you can buy more for your money. If you're on the fence about buying another property, lock it in now and get better financing on it. I'll say we listed a 2-unit property in Pennsburg, and it has been on fire. It's 24 hours on the market. I'm expecting offers on it. The clients are excited. That's what's happening out there because money is cheap right now, and it's anticipated to get a little bit cheaper before it goes back up again. So now's a great time to buy another property and save on financing. Something else to talk about, 1031 exchange. So many investors out there know what this is. Some people don't know what it is. So with a 1031 exchange, if you are selling a piece of real estate where you could potentially have a taxable income from proceeds, you can have a third party hold your proceeds and reinvest it into another like project without paying taxes on it this year. So say I own a 3-unit property and I'm selling that property because I'm going to make $50,000 on it, but I want to buy a 10-unit property. I can set it up as a 1031 exchange once I put that property under agreement to take that $50,000, have a third party hold it, and then reinvest it into the 10-unit and not have to pay taxes on that $50,000 profit that would have been realized this year with the sale of that property. So if you are selling investment properties and buying investment properties within 6 months of each other, 100% you should utilize the 1031 exchange to defer tax amount on your gains. So wanted to talk about 1031 exchanges. They are awesome to use if you're an investor and selling properties and either upgrading your investments or downgrading your investments. But if you're making a move where you're taking that same money and investing it in again, you should definitely do more research, possibly even come in and talk to us. We can help make it happen for you. We can help you find another project to invest your money in if you're selling something, but definitely awesome tax saving plan that you should be using. So talking about that scenario, you have a $50,000 profit. So if I bought this property in my personal name, Stephanie bought it, Stephanie sold it, now I have to pay taxes on what's considered a capital gain because it was a personal property if I was not occupying it. Where if you have been set up as an LLC or a corporation or an S Corp, now you would be taking that income, that $50,000, putting it into that business. Now you can deduct other expenses, your general operating expenses, if you have an assistant, gas mileage, driving back and forth between property management, things like that. And now that $50,000, you can maybe get down to $10,000 or $15,000 worth of income. Now, what that LLC is, or corporation, is what's called a pass-through entity. So while you are recording that income into that entity, you're also able to write off what that income cost you. And now that $15,000 profit that you whittled it down to is what you were taxed on through your individual tax return. So there's another way to save where you could have been taxed on $50,000 at 22%. Now you're getting taxed at 22% on $15,000. So my best advice for investors starting out, definitely get set up with a pass-through entity. One, for liability reasons. We talked about it when we talked about insurance a couple months ago. Liability as well as taxation purposes. So sometimes I'm at a loss for words. The real benefit is the fact that your entity that owns properties or manages properties or buys and sells properties, it is its own entity, which isolates you from it, but also isolates your income from it, that you can choose through your deductions what it is that you're paying taxes on through your personal income. Also, pass-through entities are less likely to be audited than a personal return. So if you file 3 business returns and they all pass through income into your personal return, it is a known fact through the IRS, I don't know the statistics, but my accountant even told us this, that it is more likely for your personal return to be audited than a pass-through entity return. They rarely look at them because payments don't come with the pass-through entity return, they only come with personal returns. So another food for thought, less likely to be audited, but then again, always use an accountant and somebody you trust to do your taxes for you. That's going to be a personal tidbit too. So I used to have a photography business, I repurposed it. Now I flip houses under it. I invest with it. But I used to do my tax return myself. I was paying more tax than I should have. So the cost of hiring an accountant will likely save you more than you would have spent in overpaying taxes that you shouldn't have. So I will also tell everybody, definitely use an accountant. Don't do your own taxes. It will maximize your deductions as well. And your accountant will think of things that necessarily you didn't think of. So I had that question this year. Did you pay real estate taxes on the new building you bought? Yes, that's a deduction. Did you do a fit out to the new building you bought? Yes, that's a deduction. And I wasn't thinking to write off the fit out on our new office building that we purchased. So he saved us money up front, even though we're still waiting on our return to know exactly what our liability is this year. And that's the part where April 15th rolls around and most investors are pretty sad that they see their tax bills. Something else I want to talk about, because I'm going to get off the topic of paying your taxes, opportunity zone. So we have talked about this before in group, in person. I've talked about it individually with some investors. But the opportunity zone is awesome legislation that came out with the Tax Reform Act that designates specific areas that you can invest your capital gains into to grow your money tax-free. So there's a 5-year, 7-year, if you keep your money in that investment for 10 years and you increase the basis value of that property by their specified amount, that now that $50,000 income that we were talking about, if you did not do a 1031 exchange, that you can put that $50,000 into a property. Say, let's just do an example. Property in Phillipsburg, New Jersey. Most of that town does qualify by address. So you take $50,000, you invest it into this house, you spend another $50,000, and now you hold on to this property as a rental for 10 years. It's probably worth, $115, $125 when you finished it. Bought it for $50, you put $50 into it. You increase the basis by enough to qualify for opportunity zone tax deferment. Now this property 10 years from now is worth, with an average appreciation of 10% per year, let's just say it's worth $175. Worst case scenario, your tenants didn't take that good of care of it. So now that $50,000 that you had originally invested that was tax deferred has now grown by $125,000. And because you invested it into an opportunity zone project, that money after 10 years is tax-free money. Tax-deferred capital gains, tax-free appreciation. So if you'd like to learn more about the opportunity zone and the areas that you can invest in with the opportunity zone, that's something as a realtor I can help you with. What properties qualify, what is the potential of this property. But you see a lot of huge investors. I mean, they're building all those huge properties downtown Allentown right now, the 300-unit apartment buildings, the PPL Center. All those projects are in the opportunity zone. So you have big investors coming in and basically wiping out an entire block and rebuilding these amazing new buildings that they're going to capitalize on these tax-free appreciation and tax-deferred legislation that were part of the Tax Reform Act that was passed in 2018. So another great opportunity to talk about tax savings is to kind of shelter your money and put it into another project, whether it is an opportunity zone qualified by address, or if it's not. If you use the 1031 exchange to take your profits from one property and move it to another. Another thought behind this is a self-directed IRA. So if you were taking that $50,000 profit and now you're putting it into a self-directed IRA, you can use the money without paying taxes on your profit to invest in other projects. So if you take that $50,000 and say, I'm going to flip a house in Allentown. So I buy it for $40,000, I put $10,000 into it, I resell it for $100,000. Now you put your $50,000 original investment back into your IRA, and the profit that you made on that project goes into your IRA as well, and you're not paying taxes on it when you sell the property. There are some awesome self-directed IRA companies that can assist you with this. I also have a great reference with New Direction IRA that you can take your retirement accounts, your 401ks, and roll them into a self-directed IRA, and then you can use your own retirement money to invest into your own projects and make more money for your IRA than you would with stocks and bonds and mutual funds and investing in the stock market. I've talked to quite a few financial planners, showed them what I was doing with investing in real estate, and said, what can you offer me? What can I invest in? And I've been told by numerous investment partners, investment portfolio people, keep doing what you're doing. You're making a better return than I can make for you. So that's what we do. We use our own money and invest it into our own projects and grow our own money, which is awesome. I'm also going to talk a little bit about tax loss. Can't talk today. Tax loss harvesting. So this is where you would minimize your taxes owed after depreciating a property, and you can increase your long-term returns on that property as well. So it also helps you offset capital gains on income that you're making off of a real estate investment. So I know that that is a lot of information and a lot of me talking. I know there's a few of you guys logged in. If anybody has any questions, just put them in the comment box. Try not to be stressed out this time of the year with taxes. I know it's always rough when you get that final tax bill, but my policy has always been we do not pay quarterly. We pay at the end of the year because we can use that money that we would have paid for quarterly payments to invest in other projects and make more than what our penalty is for not paying quarterly payments. So that's something else, just a personal preference. What we do is that we wait till the end of the year, whatever our actual tax bill is, we make our payment. That way we're not giving the government tens of thousands of dollars in taxes that we don't have to until it's due at the end of the year. And we don't always know exactly how much our tax liability will be, how many projects we invest in. So we don't want to overpay either and give the government a free loan of our money when we could be investing it into other projects. So lots of great thoughts on how to save money, getting your income taxed as ordinary business income instead of capital gains, or including it on your personal return, using 1031 exchanges, using the opportunity zone legislation and investing in real estate, which qualifies by address in the opportunity zone, using some tax loss harvesting techniques by selling investments once you've fully depreciated them, and then using a 1031 exchange to put it in another property where you can start reaping the benefits of more depreciation as well as income. We did talk about self-directed IRAs for funding your own projects and making yourself your own money. And we did talk about right now what's happening in the market, that interest rates are going down on traditional financing, which means they go down a little bit on commercial, they go down a little bit all around. So definitely if you have any properties that you have financing on right now, take a look at what your current interest rate is and start shopping around. Call some lenders. The market's been on fire. There's a lot of lenders super busy right now because people are realizing, hey, I'm paying 5 1/4 on this. I could be getting 4 1/4. That's worth refinancing right now. So I actually do have a question. I'm going to take a look at this one. Is it better to sell a rental property that is fully depreciated or hold and pay the extra taxes? In my opinion, you should sell a fully depreciated rental property, whether you sell it to another entity that you own so that you can start a depreciation schedule again, or sell it, do a 1031 exchange, buy another property, and start a new depreciation schedule. So you want to maximize your tax saving benefits for having that rental investment property. But if it is in an opportunity zone, don't sell it before your tax savings are realized. So the 10-year mark is opportunity zone. So do you guys have any more questions, any other topics anybody would like me to talk about? I'm happy to have anybody pick my brain over topics that they're thinking about, what could save them money, or just an investor question that you have right now. I know we only have a few logged in, but the bright side is of this, it is recorded and available for you to log back in, play it again if you want to hear it later, or the folks that actually like to take a lunch break they they'll watch it tonight or tomorrow morning. So I love the fact that we can record our topics and people can log in and view whenever they want and replay them if they think they missed something or they want to hear it again. So I will leave everyone with those thoughts today since I don't see any more questions or comments. If you need me, you have questions, want to set up a one-on-one, see how I can help you with real estate investing and your investments, I'm happy to do that. Would love to do that. Actually, love helping people get a great deal on a property, get instant equity, or get at least a 10 cap on return on investment. And have a great day, everyone. Make it awesome.